Okay, let's get started with Chapter 8. I'm going to split this video lecture into two. One will deal with debt financing and the other with equity financing. Take a moment and review the objectives for this chapter. Okay, let's get started. A business often has to buy large ticket items for which they do not have the cash available. And in order to finance those purchases, whether it be a new building, an addition, equipment, a fleet of cars, they will often take out loans or other forms of debt to finance those items. There's two ways that a company can finance their operations. They can do that through debt financing, and we're all familiar with that, taking out a loan to buy a car. That's debt financing. We use someone else's money to buy what it is we want. Or equity financing. Equity financing is kind of cool because you don't have to pay it back, whereby debt financing, you owe that money back to someone. In equity financing, in a proprietorship or a partnership, equity generally comes from the owner or owners of the company. For a corporation, they obtain equity financing by issuing stock. Think about it. Do you own stock? If you purchase stock from a company at their IPO, the initial public offering, you have provided equity financing for that corporation. And that corporation never has to buy that stock back from you. So you have, in effect, helped them finance their operations. Let's talk about typical liabilities. A lot of these we have some familiarity with from the work we have done up to this chapter. A liability is something that we owe to someone else. We call current liabilities those items that will be due within the next 12 months. They're short term. Long-term liabilities are those things that are due in a longer period of time than 12 months. Stop and think about it a moment. A long-term liability, let's say we have something that's due in 5 years. Eventually, that will become a current liability when the due date becomes less than 12 months in the future. There's contingent liabilities. Those are things that we might owe if something specific happens. We'll talk more about that in a few slides from now. First, let's talk about notes payable. Now, this portion should be very familiar to you. We've talked about notes receivable, when someone or another business owes us money and they have it on a note. Well, notes payable is just like that, except it's opposite. We owe someone else. Notes payable are issued in several different fashions. Sometimes we may have an accounts payable that is such a large amount that paying it on its due date in 30 to 45 days may not be feasible. So we swap it out for a notes payable that gives us a longer period of time to pay. Or we may actually use a note to purchase some item or merchandise for resale or some other type of asset. We have the borrower and the lender. Very similar to notes receivable. And because a note is a more formal document, and generally for a longer period of time, there generally is interest assessed on the principal. So let's assume that a business issued a 90-day 6% note for $1,000 to satisfy an accounts payable. What this is telling you is there's already an accounts payable for $1,000 on the books. So we're going to satisfy that payable and move it to a notes payable. This is often called reclassing an item. So the entry for that is really very simple. We're merely reducing our accounts payable and increasing our notes payable. The term of the note, the interest, none of that has anything to do with the initial entry. Now, it comes time to pay that note. First of all, we have to realize that we're going to pay more than the face value of $1,000 because we must pay interest. Do you remember how to calculate interest? Principal times rate times time. So in this case, it would be $1,000 times 0.06 times 90 divided by 360, which gives us an interest of $15. Now, when we write the check to pay the note in full, we're going to write the check for $1,015. But we only need to reduce our notes payable by $1,000. If we only made those two entries, we would have a problem because it is not in balance. So we will have not only reducing our cash, reducing our notes payable, but we're also going to reduce retained earnings by $15 because we're increasing our interest expense. And anytime we increase our expenses, we're decreasing our retained earnings. Now, my favorite subject, income taxes. I'd really like to roll into a great lecture on corporate income tax, but I would bore you to tears, so I promise I won't do that. Income taxes can include both federal, state, and any local taxes that might be due from a business. Generally speaking, corporations and people, if they expect to owe taxes when they complete their tax return, they're required to make estimated tax payments throughout the year. We're going to have to think about something different than what we've talked about up to this point. Taxable income is determined by tax law. Income before taxes, as shown on our profit and loss statement, is determined by GAAP. So it generally is different than taxable income. This is where I'd really, really like to go into a income tax lecture. If you really want to know, send me an email and I'll really, go into this. So let's assume a corporation that is on a calendar year estimates that its income tax expense for the year is going to be $84,000. If we're making our quarterly income tax payments, our estimated tax payments, we would handle them in this way. The first payment, 1/4 of or 25% of the $84,000, we would make the payment by reducing our cash and by reducing our retained earnings because we're increasing our income tax expense. Taxable income versus income before taxable. We've already looked at this briefly. Taxable income is based on federal tax law. Federal tax law often allows deductions prior to the time that we are allowed to take those same deductions on our books based on accounting principles or GAAP. So, although there may be a difference between taxable income and income before taxes, it is a temporary difference. Because if we get to take additional deductions on our tax return and thus reduce our taxable income, in future years we're not going to have that deduction, so our taxable income is going to be higher. So if we calculate our taxes payable based on our books, our profit and loss, looking at income before taxes, eventually we're going to owe the amount we calculated, just maybe not in the current year. So how do we account for those differences? According to our books, our profit is $300,000. According to our tax return, our taxable income is only $100,000. Now, if we calculated our tax expense based on the $300,000 showing in our books, we would owe $120,000. That number just absolutely baffles me. I'm not sure if I'm upset that somebody might owe $120,000 in taxes, or if I just can't imagine having to pay out a check for $120,000 to Internal Revenue Service. But anyways, based on our tax return, we're only going to report $100,000 in taxable income. That's an $80,000 difference in what we would calculate based on income. But we know we're going to owe that additional money at some point in the future. Now remember, we want our financial statements to be accurate, and part of that is accurately reflecting what we may owe to somebody, whether it be today or next year. So the entry for this would be as follows. We're going to write a check. Excuse me, let me back up here a minute. We're going to have income tax payable of $40,000. That's a liability. We're going to owe it. We're deferring some of that, so we're going to have a separate line item or a separate column for deferred income tax payable of the $80,000, because we know that although we're not going to owe it now, we are going to owe it in the future. We're deferring it to a future period. And our retained earnings, we're going to show the full income tax expense based on our books of $120,000. Take a moment and look at that and make sure you follow exactly what we're doing here. We say based on the income from our financial statements, we're going to owe $120,000. We're going to set that up in a way that we have the income tax payable, a current liability of $40,000, which we know we're going to have to cut a check for, and the rest of it as deferred because we know we're going to have to pay it in the future. Clear as mud, right? Oh, you don't know how much I would love to launch into a corporate tax lecture here, or maybe just a corporate tax rant, I'm not sure. Okay, contingent liabilities. What the heck is a contingent liability? Well, if something possibly could happen in the future. Somebody comes into my business and trips and falls. There is a possibility that they're going to sue me. So what do? I know I might possibly have a debt that I'm going to owe in the future. And we know, as I just stated a moment ago, that our financials should accurately reflect those things that we might owe. So how do we determine when we're going to actually book this item? If the liability is probable, and if we can reasonably estimate the amount, then we need to record that item in our financial records. Now, if it's probable, but we have no idea of what the amount might be, then in a footnote to our financial statements, we need to state that there is a probable contingent liability. If the contingency is only reasonably possible, it's not probable, it's reasonably possible, then we simply disclose it. If the contingency is remote, then we say nothing, we do nothing. Sometimes it's hard to determine, but you must do it with the most knowledge that you have at the time. So let's talk about payroll. Another one of my favorite subjects. Payroll is the amount that we pay to employees for services that they provide. I'm sure that some, if not all of you, work. You go to work not because you simply love the company and you want to go do things for them. You go to work because they are going to pay you for the time that you spend there. You can be paid on a salary, or you can be paid hourly. We often call that wages. In addition to the expense of your wages or salary, there are also payroll taxes, and all of these things will significantly impact the net income of the business. Most businesses, even small businesses, because we're talking about such small amounts, even a employee making minimum wage can significantly impact the bottom line of that business. It's all relative. Now, when we're talking about payroll, we have to consider not only the hourly rate, but all the things that are deducted from that payroll check. The company's expense is not the amount after deductions, but it's the full amount of your pay. Look at this spreadsheet here. The full amount, the gross payroll, was $13,800. But the cash we're paying out, the paychecks we're writing, is only $10,830 because of the items that we deduct. Now, a company does not get to deduct those items and keep them. They deduct those taxes or union dues or many other things, and then pay those amounts on to some other agency. Did you hear that? Pay those amounts to someone else. Aha! All those things that are deducted from a paycheck become payables. We're only looking at the most common deductions here, but we're looking at FICA, federal income tax, and state income tax. Let's look at the information. Assume that FICA, and FICA is Social Security and Medicare, is 7.5% of the gross payroll. And then the amounts for federal and state withholdings are given to us, not a percentage. So we take the $13,800, multiply it by the 7.5% to determine the FICA amount payable, $1,035. We deduct that from the $13,800. We deduct the $1,655 and the $280 to determine that our net pay is the $10,830. And then you will see there the accounting entry to enter this information in our books. Now I'll tell you now, there's an extra credit question on the test that has to do with payroll. So this is something you may want to kind of jot down somewhere. But remember, I didn't tell you that. In addition to what we pay our employees, there are employer taxes also that the business pays on top of what we pay our employees. Employer taxes include FICA, but wait a minute, that was deducted from the employee's pay. Aha! The employer matches what is deducted from the employee's pays for FICA. Remember, I said that's Social Security and Medicare. So for every dollar deducted from a paycheck for FICA, the employer matches it with another dollar. The employer also pays federal and state unemployment taxes. Payroll taxes become a liability when the related payroll is paid to the employees. So we've already looked at the entry where we've set up the liabilities for FICA, federal withholding, and state withholding taxes from the amounts that we deducted from the employee's pay, but we also need to make an entry for the liabilities that are going to be incurred by the employer because of that payroll. That liability is reduced when we make those payments to whichever agency, IRS, PA Department of Revenue, etc. Some of those are due monthly, some are due even more often, some are due quarterly. But the liability is reduced when we make those payments. And again, I could go into a real long drawn out payroll lecture here, but you're probably bored enough without me doing that. So let's record the liabilities for the employer's payroll taxes that will become due because of the payroll. Now, in this case, we're going to be given the amounts. We know that there was $1,035 withheld from the employee's pay for FICA taxes, so the employer is going to match that, $1,035. FUTA, which is federal unemployment tax, we're given a dollar amount of $145. SUTA, state unemployment tax, we're given a dollar amount of $25. When we record those three payables, we will total those to come to $1,205 which will reduce our retained earnings and become a payroll tax expense. Now, do you remember that extra credit question that I didn't tell you about? On that question, you're going to be given a percentage for federal and state unemployment tax, so you're going to have to calculate the dollar amount. But again, I'm not telling you anything about extra credit questions. Now, we've talked about various liabilities that a company might entail. Now we're going to talk about bonds. And bonds sounds like a very scary subject, and if you've already read the chapter, you've probably gone, oh, no, 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 I don't want to learn about this. But a bond is only a form of an interest-bearing note. It's not really as scary as it sounds. Generally speaking, on a bond, instead of paying the interest at the time you pay the bond in full, remember a bond is something where someone has loaned us money on a bond and we must pay them back. Instead of paying the interest at the time the bond comes due, like you would on a notes payable, interest is paid regularly throughout the term of the bond. And in most cases, we're going to look at it being paid on a semi-annual or 6-month basis. At maturity, we will only be paying back the face value. If you've ever heard of a bond indenture, that's simply the contract between the company and the bondholders. Whereas a notes payable is one large amount that we owe to one person, a bond issue is divided into a number of individual bonds. The reason this is done, let's say a company needs to borrow $1 million to expand their plant. Getting $1 million from one lender can be difficult because whoever loans you the money has a large liability. What if you can't pay it back? So often, doing a bond issue is a way to spread the liability. If I need $1 million and I do it by issuing $1,000 bonds, I'm spreading that liability over a whole lot of people instead of having one lender being responsible for it all. Now, the price that they're willing to pay for the bonds depends on what's the face amount. If the face amount is $10,000, fewer people are going to be interested in buying. If it's $1,000, I might even buy a bond. The interest to be paid on the bond and the current market rate. So all these things play into whether I want to buy a bond or not. So let's assume my company issues $100,000 of 6% 5-year bonds with interest of $3,000 payable semi-annually. Okay, stop and think about that for a minute. That was a lot of information. $100,000 times 6% would be $6,000. Oh, wait. Interest of $3,000 payable semi-annually. There we go, $6,000 annual interest. Remember, interest is always stated on an annual basis. So, I issue these bonds. Everybody buys them. It's wonderful. I get $100,000 in cash, so I increase my cash, and now I have a payable, bonds payable, because I have to pay that back. Now, 6 months later, it's time for me to pay the interest. The interest, the stated interest on the bond is 6%. So I'm going to cut a check, or probably a number of checks, but the total is going to be $3,000. I'm going to reduce my cash, and notice I'm not using the bonds payable account because this is interest that I'm paying. So I'm going to reduce my retained earnings because I'm increasing my interest expense. 5 years from now, it's time to pay off those bonds. So I'm going to write a check or a number of checks that total $100,000, and I'm going to reduce my bonds payable by $100,000. So there you have it. I issued my bonds, I got my money, I paid my interest over the term of the bonds, and then I paid my bonds in full 5 years down the road. Now, we need to talk about one little odd thing about bonds. You knew it wasn't simply that easy, didn't you? The market rate is the contract price. The contract rate. The selling price is the face amount of the bonds. But sometimes you can't get the full amount of the bond. Remember a few slides earlier, it said the most common denomination of a bond is $1,000. If the market rate of interest is greater than the contract rate, why would I want to pay $1,000 for a bond when I can invest it somewhere else and get more in interest? Now, go back. If the market rate's the same as the contract rate, then sure, I can sell them for the face. Because if I'm paying 6% and the market's paying 6%, great deal. Especially when it's guaranteed for 5 years, because who knows what the market's going to do in 5 years. But if the market rate's more, why would I pay $1,000 for a bond? Well, then bonds are sold at what is called discount. Buyers are willing to pay and willing to buy those bonds, but they're not going to pay face value. They're going to pay a lower amount. They're going to pay a discount because they figure if I'm getting less in interest than I could be earning in the market, then I'm going to pay less for the bonds. If the market rate is less than the contract price, then buyers are willing to pay a premium, meaning they're willing to pay more than $1,000 for those bonds. So it is necessary to know the market rate, whether you're the buyer or the seller of the bonds, and to plan accordingly. Now, with that, I'm going to end this lecture. We've talked about various liabilities. And I'm going to let you absorb all that, and I will do a second lecture on stock issuance because it gets a little complicated. Thank you, and if you have any questions, please let me know via the discussion board.